You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well today. Big question of the day. Is a stock like Dollarama is to be considered a dividend stock, right? Offers a yield of 0.30%, but man, have you looked at the latest quarter? Last week, Dollarama reported another solid quarter with revenue up 7%, earnings per share up 19%. I'm just using rounded numbers. It's just easier for the podcast, right? For you to listen. This increase of growth was driven by a higher number of stores. So last year in 2023, in July of 2023, the company had 1,525, so 1,525 stores. And this year we're up to 1,583 stores, and also increase of comparable store sales. So the comparable store sales is looking at the stores last year and looking at the same one this year and see if they were able to increase either their number of transaction, the average size. So we're talking about the ticker, and this result was that the comparable store sales increased by 4.7%. So it's not just about growing by opening new stores, because of course you open a new store, you make more sales. That's kind of like automatic, right? But it doesn't necessarily mean that the existing stores are performing. So the comparable store sales for this type of business is really important. And in this case, mid-single digit growth is really solid. We see a similar trend with their 60% stake into Dollarcity. So Dollarcity is in Central America. It continues also to grow by opening new stores. We're talking about 23 new stores this quarter. So another pretty solid quarter for Dollarcity. Finally, earnings went up like faster by 19% than revenue at 7%, mostly because gross margin actually increased from 43.9 to 45.2. So long story short, the company is making more sales because it's opening new stores. It's also able to boost the existing the existing sales in their stores, and they have improved their margin by focusing on their own products. So kind of like the perfect trifecta of a company, right? And if you look at the company's dividend triangle, it's nearly perfect. Over the past 5 years, revenue has increased double digit at almost 11% per year. Earnings per share almost at 17%, and the dividend followed at almost 12%. So when I tell you about those numbers, if I just put the yield aside, I'm pretty sure you would have been quite excited about Dollarama. The problem with Dollarama is the yield for a lot of investors. We're talking about 0.30%. So even if the dividend is on pace to double every 6-7 years, it's not enough for a lot of investors. And it's kind of ironic because I've seen a lot of people over the years telling me that I should not use the moniker the dividend guy because I like those type of companies. Full disclaimer, I do not have Dollarama in my portfolio, but that is definitely a good fit. But I do have a lot of companies that have a similar profile, not necessarily a similar business model, but really a similar profile where they show strong revenue growth. They're making more profit year after year. So the earnings per share keeps on increasing. And of course, I focus on dividend growers. So companies offering me mid-single to high single digit, sometimes double digit dividend growth rate year after year. Good example would be like Stella Jones or Alimentation Couche-Tard that I'm well known for liking it, right? Now, in my perception, there are two types of dividend investors, and that's probably where there's some confusion or difference in the perception. And I'm not telling you that my view is the best. I'm just telling you what I see on the market. So first, we have what I would call the classic dividend investor, the one that is looking for income. So he's looking for 4, 5, 6%. The higher the yield, the better. So most of the time, in the investment thesis for a dividend investor that seeks income, the yield will be part of it. Oh, I like this company because it's offering me a high yield, and they see what I like to do, what I like to call the napkin calculation is if I invest $100,000 in a stock that pays a 7% yield, that makes $7,000 per year. I want to build that passive income, so the more companies I can found like this, the faster I can retire on a pretty high yield. On my side, I'm quite the opposite. I'm the type of investor that will fall in love with a company like Dollarama. And I'm actually biting myself because I didn't never pull the trigger on this one while I've been sitting on the sideline looking at this perfect dividend triangle shaping. The reason is I am a dividend growth investor. So as opposed to the dividend investor, I am completely indifferent between a 0.30% yield and a 5% yield. I really don't mind. I can have both in my portfolio. I don't mind at all because what I do is I focus on the dividend growth first, and I use the dividend metrics. So the dividend payment, the increase year over year, the trend over the past 5, over the past 10 years, the dividend history, the payout ratio, all of those new financial metrics that you cannot find on a non-dividend paying stocks. I like to use those dividend metrics to analyze the business. So it's a new set of information that is being given by those dividend payment. A growing dividend will tell me that management is confident in their business model. They're confident that they will be able to sustain and grow this dividend over time because they believe they can increase their sales and they can increase their profit. Because without no sales growth and earnings growth, you're not going to get any dividend payments, right? So long story short, I want to invest in thriving businesses. And yes, I will consider a company like Dollarama a dividend stock because my goal here is to focus on dividend growers and not necessarily getting that high yield right up front. In fact, if you can show me a 5 yield stock with high single to double digit revenue growth and earnings growth, and on top of that, it offers like at least a mid-single digit dividend growth, well, I'm in. I'm all about those. The truth is, you won't find those easily. It's going to be very hard actually to find any stock that will qualify with thriving business, high yield, and constant dividend growth. They're kind of like a unicorn. And tomorrow I'm going to talk about why it is so hard to find those type of businesses, or if they exist altogether, right? So it's easier sometimes to find a 3-4% yielding stock with those parameters, which is great. And I do have like plenty in my portfolio as well. But the point here is really, I don't focus on the yield. I focus on the dividend growth, and I use the metric to analyze a business. If you're about to retire, you may disagree with me. You may be thinking, well, Mike, that doesn't make any sense. If I'm about to retire, I need yield. So your strategy is not a good fit for me. And I'm sure that whenever you will retire or you're going to be older, you're going to change your strategy. Well, actually, I won't. I've been investing the same way for more than a decade now, and I seriously intend to keep that forever. And I will tell you why and how I intend to retire with this type of portfolio in my next webinar that will be this Thursday. So you can register at moosemarkets.com/webinar. In this webinar, we're going to tackle 3 topics. It's all about retirement. So we're going to look at how you can build your portfolio, how you can create a sustainable income source from your portfolio, and then we're going to talk about the sequence of withdrawals because that is super important. So sequence and mechanic of the withdrawals. This is what we're going to talk about. It's 100% free. If you register, you will receive the replay link in your mailbox. If you don't, well, you're not going to receive it if you're not on my newsletter. So moosemarkets.com/webinar. So this is where we're going to talk about retirement. And tomorrow, I'm going to see what is the difference between a high yield and a low yield stock and why they're like that. Like why there are no companies paying a 5% yield and showing amazing metrics. So we're going to discuss this tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.